Good morning, good afternoon. So this video will be on power of three, the power of three. So first and foremost, we have to understand a candlestick. You must first understand what comprises a candlestick. That is the skeleton of a candlestick to understand what we're about to discuss right now. So let's say for a bullish candlestick, when you have a bullish candlestick, this is the skeleton, this is the inner workings of what goes on inside of that bullish candlestick. So you have the opening price here, the low of the candle, the high of the candle, and the closing price here. If you toggle your chart into the bars using the by your top left, there's a place where you can toggle your chart from a candlestick to a bar stick. So if you look at your bar chart, every single candle is represented like this, then the opposite for a bearish candle. So every green candle has an opening price like something like this. Every green candle has an opening price, then it makes a low, then you have an expansion leg higher, then price makes a close. So this is how the bar chart is being interpreted. Understanding a chart in that aspect, in that manner, will help you see the marketplace in the simplest of forms and avoid being distracted by the candlesticks, because the back and forth of the candlesticks, it is meant to be a psychological warfare. So to interfere with your level of attention if you are not paying attention to price and time. So the power of three. What is the power of three? The power of three comprises of three phases. You have the accumulation, then you have the manipulation, and finally you have the distribution. These are the three workings, these are the three phases of the power of three. This is what the algorithm does to engineer liquidity, to pair up liquidity from the opposite side of the market and rally higher and then makes a close. So for the opening price is the initial value price before price creates an imbalance. So this opening price here, it is the beginning price before price makes any form of imbalance in price. So this opening price is a constant, and you have two major opening price for the New York session. For that is you have the 8:30 a.m. if you are trading the New York morning session, and you also have the midnight opening price. That's New York midnight. Everything we are discussing, everything in relation to time, your chart should be toggled to New York time zone. So New York, no matter where you're located on planet Earth, your trading view chart should be toggled to New York, because the algorithm operates on New York time. I don't make the rules. That's as it's been. This opening price is a constant. And this midnight opening price, the midnight and the 8:30 a.m. We'll discuss other times like the afternoon, but in this mentorship, we are more focused on the New York morning session trading window. So you have the midnight opening, and you also have the 8:30 a.m. opening. This 8:30 opening is when the market opens for the morning session. You also have the 9:30 a.m. Equities open. But once you practice, once you start practicing with these two basic time windows, you will understand when to use either of which, and to using them to map out price. It will give you more insight on how bullish or how bearish the body of price action is. So we'll talk about that as we go forward. So what is the accumulation phase? So during this accumulation phase, the accumulation is at the opening price. So for this candlestick, using this candlestick as a reference point, the accumulation phase starts at the opening price. So what is being accumulated here? It's smart money long position. So at this opening price, smart money traders will be filling in their long position during the accumulation phase. And after that, you have the manipulation. During this manipulation phase, there's multiple things that goes on during a manipulation leg, and you have to be aware of these things that goes on because it is vital to your understanding to understand and follow what the market makers are trying to do. So when you interpret this after multiple times, the process and the inner workings of the algorithm will be engraved inside of your subconscious. So during this manipulation leg, there's three major things that goes on. The engineer short liquidity. What do I mean by that? Remember from the market efficiency paradigm video, from the first video, we noted that smart money traders, the algorithm makes use of retail logic, retail traders liquidity to pair up smart money entries. Market efficiency paradigm, you have two separate entities. Let's use it. You have the speculative uninformed money here. Sorry, you have the smart money here. Let's call them SN. You have the smart money here, and then you have a large crowd. You have a large crowd, large in quotes, because their size doesn't really matter to this illustration. Then you have this speculative uninformed money. Let's call them some. So these two entities, they are what participate. They are the both entities that are participating in the marketplace, the smart money and the speculative uninformed money. So during this manipulation leg, this is when price goes to create short-term liquidity, to engineer short liquidity. For a bullish, we are using a bullish example. They want to sell after price takes out a support level, and when they enter their sell position, this sell position will be used by smart money as a counterparty for smart money buy entry. So that is why we have something like this with this diagram. Just remember the market efficiency paradigm when you are looking at this diagram. Just remember the workings of and the explanation of the market efficiency paradigm, because that is what goes on inside the marketplace. That is one of what goes on. They engineer short liquidity to trap short traders during the manipulation leg. Here you have the manipulation leg. The manipulation leg takes place usually below the opening price. The opening price is when the opening price and the is when the accumulation legs takes place. This is when smart money accumulate their long position. So that means before the general public even comes into the market to start trading and start battling for where they expect price to go to, smart money traders are already in the know. The people that are already in the know, they are already aligned themselves and position themselves inside of the market. So here you have the accumulation leg. Let's make this blue. So the second form of manipulation that takes place in the market is the algorithm will take out the long traders, the retail traders that entered long position here. How it does this is that because they place their stop loss below old lows and above old highs, so the algorithm will create when the accumulation leg starts, the algorithm will create a low which will look like a strong low, probably a low or relative equal lows, that is double bottoms. And when it does this, retail traders will see this as a strong level that they don't want it to be violated, so they'll place their stop losses under this place, expecting higher prices. That means they are correct in their bias, but they are not correct in how they engage in the marketplace. So when the market does this, during the manipulation phase, price will come and take out their lows, will take out their stops and rally higher. During this time, because they want to go long here and place their stop here, they will have what they call sell stops below here, which is sell side liquidity. This sell side liquidity now will be used as the by the algorithm again to facilitate buy entries by smart money, because smart money pyramid their entries. They cannot enter their full position during this accumulation leg, so they will enter a portion of their entry, and when price goes lower, they will enter a portion of their entries again, and they make use of these sell stops by traders that trade with a flawed logic, with a support and resistance logic. So they'll place their stop loss at this low or at relative equal lows. So when price trades below it, it will neutralize their buy orders and make this their stop loss order become market orders for smart money buy entries. During this manipulation leg, they will make sellers, people that want to go short from here, people that want to trade for that are expecting lower prices, they will neutralize them. And people that are expecting higher prices, they will also neutralize them. So they will be confused on the direction of the marketplace, either going higher or going lower. So the market wants to paralyze them. So it does this during the manipulation phase. So when it paralyzes them, then the price makes its impulse swing higher. Then you have this distribution phase higher. When you are dealing with the power of three, you do not exactly concern yourself with the closing price. You do not really bother yourself with that. You're only concerned with the opening price, the low, the manipulation leg, which typically forms the low, then the range expansion. That range expansion, that distribution phase, that is the phase you want to participate in. And during this distribution phase, this is the liquidity that was taken, that was paired from these sell stop orders, from these retail traders stops. The liquidity that smart money used to facilitate their buy entry, they will now offload at a previous high or at a form of imbalance above the marketplace. So that is where they will that's where they will exit their long position with resting buy interest. They will make retail traders, the uninformed money, this speculative uninformed money, they will take price higher to bring in buy interest by those traders. because they do not understand the concept of when price is at a premium price, that is an expensive price, or when prices are at a discount or a cheap price. So price will, after this rally higher, it will create a form of illusion to bring in buy entries by those speculative uniform money. And those buy entries, it is what the smart money traders will use to offload this their buy position. This their buy position, which was taken from this sell side liquidity, they will use it to offload at buy side liquidity when price is at an imbalance or above an old high. So let's look for chart example to illustrate this. Like I said earlier, the concept of power of three is a time-based tool. Every tool in ICT's concept, in ICT's repertoire, it is they are all time-based tools, apart from the SMT. This is why I don't always rely on the SMT while trading, because the SMT is a confirmation tool and not a precision tool. It is not the time-based tool. All time-based tools are precision tools. So when trading, you map out your opening price. This is the opening price where the accumulation takes place. This is your midnight open. So for here, you have your midnight opening price. And when you are bullish, you expect to see price trades below this midnight opening price, preferably doing London session, which is from the 2 a.m. to 5 a.m. window. You want to see price trades lower below this midnight opening price. Below the midnight opening price, this is when the manipulation legs will take place. When price trades lower like this, you have an expansion leg higher, which is a distribution phase now, because you have this accumulation here, then price trades lower, creating a manipulation to take out traders that want to go long, from this relative equal lows. These are relative equal lows here, or you can use this. These are relative equal lows. So here you have sell stops resting below this. Below here you have speculative uniform money. Their sell stops will be resting below this position, below this level. So they want to go long here. So price will come down to take out their long position here. And when it does this, it creates another form of liquidity again. Till the key zone has reached to participate in the market, price can still continue its manipulation leg multiple times, so it can engineer liquidity on both sides of the market and take out early participants in the market, people that do not trade with time in mind, people that do not trade with respect for time. So price will keep on punishing those individuals. So you had this manipulation leg lower, then price while it's higher, this expansion leg now is synonymous with this. After this is synonymous with this impulsive swing higher. So you have this expansion leg. So doing this expansion leg higher, if you do not participate during the manipulation leg, you wait for an expansion leg. As earlier stated, you can use the power of three to understand how bullish or how bearish the marketplace is at that intraday trading. So the market can be an extremely bullish market, or you can have a high resistance liquidity one bullish market. So the market can just be trading smoothly, going higher smoothly without much resistance. And you can also have a market that has resistance going higher, trading like this, something like this. This is a high resistance liquidity on market. So using the power of three in mind, it can help you understand, to plan, to understand what form of market profile you will be having for that trading, for that intraday trading. So the other time window you have for the power, for using the power of three, is the midnight, is the 8:30 a.m. window. So here you have the 08:30 a.m. window. And from this body of price action, when price trades lower after the 8:30 opening, this now is the manipulation leg lower, and price makes an impulsive leg and rallied higher, being interested in this buy side liquidity. Here you have chart, you have the market interested in buy side liquidity resting above this price level. This is, you have buy side resting here. So when price made this leg higher, you place your entry at the eye of this imbalance here, your stops at the candle that makes this imbalance here, because you already have the manipulation leg already took place. You have the manipulation leg taking place after midnight and after the 8:30 a.m. So you don't want to see price trade lower here to this low, and also this low that pushed out sell side liquidity. So during this expansion leg, during this distribution phase, this is where you have a higher probability trading, because you already have the manipulation, you already have the accumulation phase and the manipulation phase behind you. So if your trading model relies on you waiting for the accumulation and the manipulation phase, it is more beneficial to you because you already have those phases behind you, so you can trade the distribution phase, because during this distribution phase is when you have this expansion in price, so you are waiting for a retracement in price to either buy at an order block or rebalance an imbalance to look for fair value in price to take price higher. So if you miss this manipulation phase, this is why I'm talking about this distribution phase now, because you do not need to participate in the low, you do not need to buy the low of the day. You can just take your portion, you can just take your meat from the during the distribution phase, which is this, all of this, when price was distributing to the upside. So you can just come into the market after the accumulation and the manipulation leg has taken place, and this typically goes on during the London session. The London session typically makes the low of the day, and if it does not, the New York session will make the low of the day. And if the New York session before the 9:30 opening price makes the low of the day, if the manipulation leg for the 8:30 window already makes a low like this and price rallies higher, this is indicating a very bullish price action. So you're expecting price to offer a lot of, you're expecting a very large range day. You're expecting a large delivery of price. Now, this is what I was talking about. You had this manipulation leg lower, which the manipulation takes place below the midnight opening price, and also after the 8:30 a.m. opening price made its manipulation leg lower. These candlesticks now, these two last down close candles, now is price manipulating and making uniform money think we are now going for lower prices, so they will sell. When they sell at this 8:30 opening price, their stop losses will be here, above this relative equal highs, and above here. So when they place their stop losses here, you smart money traders now will enter during this retracement lower, because this retracement lower now has filled this other block. So has filled this fair value gap. There's a fair value gap here that price has retraced down to. So when you add this retracement in price, smart money traders will fill in their position, their buy orders here, targeting these highs, these relative equal highs, these highs, and probably the previous day's high. So you add that here, the accumulation, the manipulation leg lower, then the distribution fee is lower. This was the business for yesterday's trading. So we bought this when price trades, made this retracement inside of this fair value gap here. After making this order block here, you have the bullish order block here, which has this fair value gap also resting just above it. So here you have this fair value gap. So after price trades inside of this fair value gap, we got in inside of the fair value gap and expecting higher prices. So price rallies higher and return back inside of the fair value gap into the order block. This is a return to order block here. So you call this a return to order block. So price does this here. So if you miss this entry here, you can place a limit order here and your stops below this low or below this week's low. But you do not expect price to trade back below this low again, because it has already traded to the consequent encroachment of this week. Weeks are imbalances, but we'll talk about that later on. So we had price rally higher and goes higher, and for this phase you do not concern yourself with the closing price. You do not concern yourself with at what price the market will close. You're only concerned with that expansion leg higher, that distribution phase. That is the phase where you want to participate in. If you want a high probability trading model, because you already have the manipulation phase and the accumulation phase behind you. So the manipulation has already taken place. So you are participating in the distribution of price. So that's what we are there. I hope you got something from this video, and I'll talk to you in the next episode. And thanks for watching. Have a great day and goodbye.